Okay, it's 9:30, ladies and gentlemen. Very, very warm welcome to you all, and welcome to this webinar presented by personalities at Sovereign and officers and personalities at Tilney's Financial Planning. I'm Simon Denson, the Managing Director of our UK operation, London operation of the Sovereign Group. I'm your chairman. Thank you to all delegates. There's cantering in, there's 15 already registered in place. We have a record turnout, 300, so thank you again for your registration, and I think that's a record turnout. Three main subjects, ladies and gentlemen: residency and citizenship, with somewhat of a focus on the UK; wealth-based strategies and solutions, that's part 2, which will be delivered by our associates, Tilney Financial Planning. Part 3 will be Stuart Stobie and myself from Sovereign, which will be delivering on a number of subjects, and a very useful part for questions and answers, taking us more or less to the hour. So thank you all. Next slide, please, Tiffany. This is what we tend to canter through, ladies and gentlemen, starting with Kerry, the resident citizenship by investment, financial planning, Jonathan and Ben from Tilney's. Part 3, the application, which will be characteristics, application criteria, case illustrations of trusts, QNUPs and family investment companies, regardless of one's residence, regardless of one's domicile, with questions and answers towards the end. I will try and take, if we're running to time, I'll take a couple of questions, especially the easy ones, before I start to introduce next speakers. Next slide, please, Tiffany. And I expect you to raise questions. Could you please raise questions in the chat box? I think that's right. If I'm not, Tiffany will intervene. Raise your questions by the chat box, and I'll raise them as often as I can, and especially in the questions and answers session towards the end. There will be a poll to complete at the end, if you don't mind doing that, and there will be a copy of the presentation being distributed to you after today and before the end of the week. The presentation is actually being recorded, and that will be available. So not exactly going on to BBC in question time, but it will be recorded for your perusal thereafter, so that you'll get plenty of time to evaluate what we're talking about. Ashwin, I get your point that you can't hear anything. You've got to go on the green button. That's the button in the click to mute yourself or unclick to mute yourself, and that will tell you, just click on it once, because then you should be able to hear us all. Don't click on it twice. Okay. Quick intro to Sovereign Group. I'm going to introduce each speaker as they come in the part 1, 2 and 3. This is a reference slide, so I'm not going to spend any time on this particular slide in any great detail. It says what it says. 33 years as a business, providing services to private clients, corporates, small to medium enterprises and others, still under independent ownership, not private equity ownership, and certainly not stock exchange ownership. We're regulated in 9 jurisdictions, in all of the, or not all, but in most of the prevailing onshore, midshore and offshore nations as a professional trustee, with 20 offices worldwide. The 20,000 clients are represented by a headcount of 475 management and staff, all belonging to the Sovereign Group, which makes us one of the leading independent and one of the largest independent groups, independent of any private equity ownership, as a trust and corporate service provider. The offices are there. As I said, I will introduce the speakers as and when they come in their various parts. Next slide, please. The speakers, I'm your chairman today, I'm Simon Denton. You've got my details there. Kerry, I'll officially introduce in a moment, and Stuart is going to be a co-speaker in part 3. Next slide, please, Tiffany. I will formally introduce Tilneys when they come to speak in part 2. And Jonathan and Ben, Jonathan Spring Rice and Ben Roberts will be starting part 2 after Kerry has opened up the proceedings. And again, a specific mention will be given to each speaker, so you are fully aware of who is presenting to you. Next slide, please. Right, to the part 1. And this is the part 1 will cover residency citizenship by investment. And that will take us through the entirety of part 1 with a particular focus on the United Kingdom. Just to introduce Kerry practically for you, Kerry has 23 years of experience working within the international wealth management sector, is a qualified member of the Personal Financial Society, and more importantly, a professional member of the Investment Migration Council. Not that many people there's not that many members of this esteemed organisation. Kerry is responsible for planning, development and implementation of the Sovereign Group's Residency and Citizenship by Investment, globally, not just the UK, globally. And Kerry will spend a couple of minutes on bringing your attention to the key areas and jurisdictions in this particular field in view of residency and citizenship by investment. Kerry, thank you. Over to you. Can't hear you, sir. Mute.
Yeah. Thank you, Simon. Yes, I'd just like to begin by providing a brief overview of the residency and citizenship programs that the Sovereign Group offers through its extensive network of offices and professional partners. We actually offer now in excess of 18 different programs. Those are spread across the Europe, the UK, obviously, and Caribbean, and they can be split into 3 separate entities. So direct investment, direct citizenship, residency, and also tax residency. And one thing that people aren't aware of is that these programs can actually be taken independently and/or they can be combined. And the idea is, if they're combined properly, then you can actually establish a very good foundation from which to build wealth management strategies. Sorry, Tiffany, could you go to the next one, please? Thanks. One thing that is key for me personally with my wealth management background is, and one thing that's often not looked at, is that when people are considering residency or citizenship, they really do they should be considering also their existing wealth management strategies. The reason being, obviously, that you can move forward very quickly and establish residency or citizenship, but it may not be the most tax efficient way for you to do it if you don't consider your existing arrangements as well. So that's why I believe that the Sovereign Group is best placed to provide these services, because obviously we have the foundation of the residency and citizenship program, the core services provided by Sovereign, which are corporate, trustee, private client, and pension. Can we move forward, please, Stephanie? Bit slow today.
Kerry, are you there?
Yes, can you hear me?
Yeah, carry on, sir. Your video's froze, your face is frozen, but carry on talking.
Okay, sorry. Could you just go back 1 slide, please, Tiffany? I'm not seeing them. Okay. Look, sorry, there's obviously been a mistake here. As we've said, we are today going to be, looking at the UK residency and citizen residency programs. And obviously, when you look at the UK, as many other countries around the world does have a number of different options available for those who wish to migrate to and become a resident of the UK. Now, in the UK, it is very important that you're dealing with a Home Office licensed immigration professional, and as such, these things are jumping around. You know, and as such, we are able to offer a number of different solutions. So those on an individual and family basis, on a business basis. So you have startup visas for those starting out in business, an innovator visa for the experienced professionals looking to enter the UK market, and also the sole representative visa, which quite simply is for employees of international firms who wish to enter the UK market. But today we're going to be focusing on the UK Tier 1 investment visa, which is actually the most popular. And, you know, as we say, there's a number of reasons why people might wish to enter the UK market. It does have a strong democratic government, a respective system of law, which makes it very attractive to those wishing to establish a tax efficient business and or personal private residence. Now, the Tier 1 investment visa program is very successful, and since its establishment in 2008, it is estimated that it has actually generated in excess of £9 billion from private investors. Now, the benefits obviously that come with that, an investor is able to live, work, and study in the UK. It only takes up to 3 months to actually establish residency in the UK. An applicant obviously may include their spouse, partner, and children. And also, more importantly, for most people, they're also able to, at some point in the future, establish permanent residency or British citizenship. Significant, as we're going to talk about later today, the UK obviously does also provide significant tax incentive for non-domiciled individuals. Tiffany, could you move on, please?
Good.
Okay, so actually the UK Tier 1 Invest program, the requirements for it are quite straightforward. An investor only needs to be at least 18 years old, be a citizen of a country outside the EEA or Switzerland. Obviously, they must have a minimum of £2 million to invest in the UK, and obviously be able to prove that those funds do belong to themselves or their spouse or partner. They need to establish a bank account. Most importantly, they need to have their funds managed in such a way that, in a manner that specified by the UK government. So, as Simon's pointed out, with Tilney, our associates will be talking about that a little bit more in a moment. And last but not least, they need to provide a criminal record certificate from any country that they've stayed at least a year in over the last 10 years. Tiffany, could you move forward, please? Thanks. Now, the initial residency visa is actually valid for 3 years and 4 months, after which they're able to extend that for another 2 years. Now, as I mentioned before, most people are actually looking to establish indefinite leave to remain in the UK, or otherwise known as permanent residency. And they are able to do that based on the timelines that are applicable are basically dependent upon the amount they invest. So if they invest the minimum amount of £2 million, they're eligible for permanent residency after 5 years. And if they invest 5 million, they're eligible after 3 years. And if they invest 10 million, then they're actually eligible after 2 years. Now, within the, one important point that needs to be considered is, in order to qualify for ILR, they do need to spend at least 6 months of the year in the UK for every year that, since they've had approval to live there. They also need to have an approved English language qualification and pass what is known as the Life in the UK test. Could you move forward, please, Tiffany? Now, after permanent residency has been achieved, investors are able to apply for British citizenship, which comes along with all of the benefits of any citizen of the UK. In order to qualify for citizenship, you need to have been a resident of the UK for 5 years, to have had ILR or permanent residency for 1 year, to have not spent more than 450 days outside the UK during the previous 5 years, and not more than 90 days outside the UK in the last year. Obviously, you also need to prove that you haven't, you don't have a police record, or you haven't been in breach of any of the immigration rules. Tiffany, could you move forward, please? The way we've established the residency and citizenship, all of our residency and citizenship programs, is to a certain extent as a one-stop shop or all-inclusive, all-encompassing service. So what we'll offer as the Sovereign Group to anybody interested in these services is obviously direct access to the Home Office qualified immigration professionals. We'll obviously, my colleagues in the UK will review existing arrangements to ensure that they're structured in a tax effective manner in accordance with British tax rules, and obviously then advise accordingly. We'll assist you in establishing the UK bank account, and as Tilney, Ben will discuss in a moment from Tilney, establish a portfolio for you that meets the government requirements. Obviously, the investment firms you're using will continue to manage that over during the period, normally 5 years of requirement, and provide regular updates with regards to any immigration rule changes, ongoing advice with regards to applying for visa extensions after the 3.4 years, or indefinitely to remain and or citizenship. Simon, I'll pass back to you.
Thank you very, very much, Kerry. I don't think we've got any specific questions at the moment. Tiffany, I don't think so anyway. So thanks, Kerry, for keeping us to time. Welcome you all again, because we've got 164 people in attendance now, and a few just drifted in just at the start of Kerry's talk. Thank you very, very much. No specific questions at the moment. We can hold questions at the end. And just one point on Kerry's talk there. I'm dealing at the moment with a Tier 1 investor application, and the applicant is fortunate to have £5 million to invest into qualifying investments, because it is her objective to get indefinite leave to remain status, not after 5 years, but after 3 years. And once you get the indefinite leave to remain status, your investment can be liquidated. Your investment does not have to remain in the qualifying investments. It can be reinvested elsewhere by Tilney's or your bank and your third party provider. So her motive was to make sure she gets the ILR status within 3 years, so that she can remove her qualifying investment, or have the flexibility of doing that, which you can on a slightly more sizable investment. So ILR after 5 for 2 million, ILR after 3 for 5 million, and it drops down to 2 million for 10 million pounds. So that was her motive, a Russian lady that is coming into the UK and wanting the benefits of UK residence and the ILR status. Whether she gets a passport and stays in the UK for the qualifying period may not be so important to her, but she just wants that ILR status under that period of time. So thank you, Kerry, on that. The next slide, please, Tiffany, because now it's, as we're running to time, and we have 164 of you listening in, so thank you for your attendance. I wish to introduce Tilney's. Tilney's is a national financial planning and investment management business founded in 1836, just a few years old, just a few years in maturity and sovereign then. Headquartered in London, the group has grown significantly over the years. 30 UK offices, ladies and gentlemen, and 1,200 management of staff. They are regulated in the UK by the Financial Conduct Authority and have a specialist London team also regulated by the SEC, Securities Exchange Commission, who provide investment advice to those US connected individuals, especially the Americans living overseas and non-Americans having an investment commitment to the US. I specifically introduce Jonathan Spring Rice, who's going to technically opening the batting for Tilney Financial Planning. Jonathan's been with the group mostly from 1990, specialises in advising both UK resident and domiciled individuals and UK resident, non-UK domiciled individuals, and I'm giving a definition of domicile later on, ladies and gentlemen, and international resident clients. He is a chartered financial planner. His colleague Ben, who will complement Jonathan this morning, joined Tilney in 2018 and provides bespoke investment advice to a range of high net worth private clients and their families, both UK and international. He's had appointments previously to Tilney's with Brooks Macdonald and Brown Shipley. Ben holds the Chartered Wealth Manager qualification, not easy to get, by the way, and is a fellow, despite his young age, a fellow of the Chartered Institute of Securities and Investment, the CISI. Welcome, Jonathan. Welcome, Ben. Opening now part 2 of the talk, and quite a lot to canter through, Jonathan and Ben. So over to you, gents. Jonathan.
Thank you, Simon. Thank you, and welcome. Good morning to you, or good afternoon, depending on where you're listening to us from. I'm talking to you today from what Stuart referred to as my wigwam, and I think Simon referred it to as a windmill, but actually it's my summer house at the bottom of my garden. A first for me, but I suspect typical of the environment we're all finding ourselves in. I'm going to talk this morning a little bit about how I feel Tilney can provide additional financial services to you, which will help your clients to meet their financial future. But before I do that, I'm going to just expand a little bit on what Simon said about Tilney. So this gives you, this slide gives you an idea of where we currently are, a wide number of financial advisors, but we also have some specialist divisions, of which I'm part of one, and that's an international side. I've been with the company, as Simon said, for a number of years, and we believe that providing specialists within certain sectors is absolutely vital to make sure that the advice anybody receives is relevant to their circumstances. Can we have the next slide, please? You may have heard that Tilney are about to merge with another company called Smith & Williamson, and when that occurs, the makeup of the company will change. Actually, our assets under management will increase to some £46 billion, and we'll have 200,000 clients globally who are entrusting us to look after their funds. Can we have the next slide, please? Later on, Simon's going to talk to you about how Sovereign are in a unique position to be able to provide the important financial structures which allow them to provide the services to your clients. I want to talk a little bit about Tilney and how we fit into the situation and how we can help with the financial planning which surrounds the selection of those structures and builds the reason for using them. Tilney, we believe, is what we call a fully integrated international wealth management service. We ostensibly provide two parts to the service, which is financial planning and investment management. But we believe that those two are inextricably linked, that the decisions you make about investment management are very often driven by a client's certain individual specific financial plans. And decisions you make about financial plans have a great impact on the investment management decision. In the case of tier 1 clients, for example, if a client's coming to the UK, we need to understand that client situation. Simon spoke a moment ago about a lady who was trying to build a portfolio in order to get the visa and in order to get indefinite leave to remain. But when she achieves that, she'll then be liquidating that portfolio. That's a quite important bit about the financial planning. Why is she liquidating it? What's she going to do with it? What's the sort of situation? What other assets does she have? Where's her family? All that situation we think is important, because then we can use that to make decisions about how the financial plan or how the investment portfolio is put together. On this slide, you can also see some of the services we provide in areas of financial planning, and I'm going to talk a little bit more about them in detail a little bit later on. Can we have the next slide, please? Strategic financial advice. This is an area which Tilney thinks is absolutely imperative to a successful financial future. So what it talks about here is starting with understanding the client's short and longer term plans. Why are they coming to the UK? How long do they intend to be here for? What's important to them? Are they going to bring their business here? Where's their wealth at the current moment? How long do they expect to live here? Where else might they live around the world? A lot of these are also important points in the equation. We also want to look at their existing overall wealth activities. So how they've been set up. Look a little bit at their family. So are their family coming with them to the UK? What are the age of their children? Are they going to be educating their children? If so, is it going to be in the UK? Are they looking to buy properties for their children because they're a little bit older? What's happening with their spouse? What's happening with the whole sort of situation? We then want to move on to areas like goals and wishes, and I sometimes put these into two groups: the sort of need to haves and the want to have. So need to haves would be areas like we need to purchase a property, we need to fund this business activity, we need to be able to pay for our education. Want to haves might be like we want to travel around the world, we want to race yachts, we want to buy art. These are need to haves and want to haves, and what we're trying to do is to establish to what extent can the clients achieve those objectives. So that's why we look at it on cash flow modeling. Effectively, what we're doing is stress testing their plan. Does their plan financially work? Does it make sense? Are there any issues? What would happen if, i.e., what would happen if somebody in the family had a family tragedy? What would happen if their business didn't work out the way they expected? What would happen if the laws changed in the country, or the laws changing their structure changed? So we need to look at all of those and try and explain to them what the impact is. What it means is that these structures, which Sovereign again will talk to you about in a moment, we can absolutely be certain that it fits with that client's particular situation, that we can provide evidence to that, puts the client's mind at rest. Can we have the next slide, please? These are just some of the services that Tilney gets involved in. So I'm talking a little bit briefly about each of them. Tax efficient investing is an interesting one. I think this is an overused one completely. I've heard the old adage, don't let the tax tail wag the investment or lifestyle dog, and it's actually very true. Now, you should never buy a structure because it's tax efficient. Why you should use a structure is because it meets your circumstances, your specific circumstances, which is why we build the plan first. If you can have a structure which happens to be tax efficient and work with your financial circumstances, we believe that's the optimal approach. There are other areas we provide advice in, like life assurance. This one actually also works for non-resident clients. With the onset of ATED, yes, there are ways of solving ATED, and again, Simon's going to talk about them a little bit later. But another option to consider might be simple life insurance. If a client, particularly if a client's not going to be here for many years, do they need a complicated structure? Actually, can they cover it in the short term by a high level of life insurance if they're owning UK property? And even if they're non-resident, they've still got an IHT liability. Pensions, this is a highly regulated area, particularly UK pensions and defined benefit schemes or final salary schemes. It's now been under the spotlight for a number of years, and it will continue to be so. There are probably too many people who transferred maybe to a cure-op at some point in time in the last 10, 15 years. And the real situation is you need heavily regulated and structured advice to make decisions on that. There are some cases where a transfer makes sense, but I would want to be certain before we made that advice that it suited that client's particular situation. Other areas like business investment relief. This is particularly bringing money into the UK for resident non-domiciles, which is not a remittance for tax purposes. They can invest it in a qualifying structure, includes enterprise investment schemes. But there are loads of them on the market, and there's an awful lot of rubbish in there. And our approach is that we have a specialist team who research those companies, who understand all those EIS offerings that are on the market, and are able to suggest ones which are suitable to our clients' particular circumstances. We also work with other professionals, so work with clients, other advisors, some companies like Sovereign, for example, or offshore trust companies. We're not tax advisors. We're not lawyers, all right? What we are is financial planners and investment managers. So we know how to manage money, and we know how to help a plan to meet a client's circumstances. We do need to use the input of professionals within other areas, the likes of Sovereign, to give specific advice into tax structures, or accountancy or legal advice. So we work very closely with these people at all times. Custodianship is another area. Ben will talk a little bit more about this. And philanthropy, this is kind of a growing area. An awful lot of interest in charitable services. how can people help charities in the UK, particularly for non-resident domiciles, been made very tax attractive in the United Kingdom. So an area which we do have a lot of clients who can help with that, and we can advise on that area as well. Next slide, please. Simon touched on this, so I won't really expand on it very much, but it's just that we have a unique point within Tilney, where we are licensed to advise and to manage money for US connected clients. We have an SEC licensed desk. We can create tax reports which are SEC compliant, and we can hold assets which are SEC compliant. That is important. There aren't a huge number of investment managers who have that capability. And again, Ben, I think, will cover on this when he talks. Next slide, please. So what can you expect from us? Well, what you can expect from us is a coordinated plan, and a plan that needs to be reviewed. I think we look after three groups of clients, actually. We look after clients that some come to us for just investment management services, and we can do that. We have some clients come to me for just financial planning services, and other companies manage their money. And we have some clients where people like Ben and I work together to provide those clients. And we're happy to go through all of those areas. But whatever you do, I think my key piece of advice to anybody is you have a financial plan, make sure it works for you, but review it, because circumstances of the client change. What are your personal circumstances? I'm often meeting clients every year. I want to know what personally has happened in their family. I want to know what's happened with their situation. I want to know what's happened to their children. I want to know what changes and thoughts they've got. At the moment we're talking about COVID, the risks and concerns they have their plans had to be changed. That's quite important, because we can then feed that back to the investment manager or to the tax people or to the structure company and say, this looks like we might have to make a change in the next 12 months. So that's my underlying key point at the end. Thank you for your time listening to me. I'm going to pass over to, or back to Simon now, who's going to pass over to Ben.
Thank you, Jonathan. And what a nice way to compliment Kerry. And this is halfway through the Tilney's presentation. Couple of questions, but points. One or two of you have had difficulty to unlock the mute, but there's a mute button in the green microphone button. So if you unmute yourselves, if you're having difficulty with the sound, there is a button that you can get the sound by taking the sound device on. The presentation is going to be delivered to you electronically, and hopefully the majority of you are still hearing us, because there's 159 of you in the webinar room. One question was, one delegate said, I need to know where Jonathan's windmill is, because it's absolutely fantastic, and I'll let Jonathan respond to that and perhaps give you the county. Don't get me going on GDPR, please. There's a couple of questions on residency and citizenship, but I will cover the easy ones before I introduce Stuart Stobie. But hopefully, as there's a static 160 now in the webinar, hopefully you can all hear us. Thank you very much. Ben, waiting quietly there, over to you to take us through the second part of this webinar. Thank you, Ben.
Yeah, thanks, Simon, and morning, everyone. So next 10 minutes, I'm going to cover our investment management services for the international marketplace. And when we say international, it can be anywhere from those looking to obtain permanent UK residency, for example, via a Tier 1 investor visa portfolio, right through to those that want to remain non-res, non-dom, keep their assets offshore. And for those that wish to stay offshore, we do have a buyer list of assets that we can populate portfolios for those clients. The investments that we're looking at are things like non-UK citus assets that are generating non-UK sourced income, and that helps mitigate any unnecessary tax charges. Just go to the next slide, please. But the main topic of today is the Tier 1 investor visa service. I mean, our service launched around 2013, so we've been managing those type of portfolios for around 7 years now. Not many people will be aware of this, but the investing rules changed in March of last year. You can no longer buy UK government gilts in portfolios. You can only buy corporate bonds and direct UK stocks. Now, from an investment point of view, that's not particularly an issue. We think gilts are quite overvalued at the moment. We see a lot more value in corporate bonds, better yield return as well. So that doesn't really concern us. But for those portfolios that were set up prior to March last year, they can still hold the UK government gilts alongside other assets. Within Tilney's, we have a couple of dedicated analysts that ensure the investments remain eligible. So Kerry mentioned before that we have to invest by the qualifying rules, so make sure that the Tier 1 portfolios are eligible. And that includes things like if you're buying a UK stock or a UK bond, the registered address must be in the UK. You can't buy anything to do with property, and you can't buy collective investments or investment trusts. It has to be direct equities. We can assist with a bank account setup, not via ourselves, but we do work with a couple of external banks. I think Sovereign can help on that side as well. And in terms of the strategies, we have 5 that we offer, from low risk, which is full 100% corporate bonds, up to high risk, which is 100% equities, and then there's a mix of the other 3 in between. And it's important to note that these strategies are bespoke. So if, for example, you have a client that's got a large holding in Royal Dutch Shell elsewhere, they don't want that in the portfolio, we can omit that. So it's not a model portfolio, and it's certainly not an execution-only strategy. It is a fully bespoke portfolio for the clients. And the only other main thing to note here is we want to work with the client's advisors from the start, because obviously when that clock starts ticking on the visa application, you've only got 3 months to do it in. So we want to make sure that we can do a lot of the due diligence and compliance checks at the outset to make sure that we don't run into any issues maybe 1 or 2 months down the line, to make it as easy and seamless as possible for the underlying clients. Next slide, please. So in terms of reporting and custodian capabilities, we've got a fairly clever CRM platform at Tilney's. It can accept third-party data feeds. So what I mean by that is a lot of these internationally mobile clients might have portfolios of wealth managers, family offices, investment banks globally. And if they're happy to send data feeds to us, we can plug that into our CRM platform. So the client can see all of his portfolios in one place. It helps us with asset allocation, investing, make sure there's no overlap as well. It does support other currencies too. So as well as sterling portfolios, we can manage dollar, euro, Swiss franc, and others. In terms of custodian, Jonathan touched on this earlier, but we've got 3 main custodians we can use. Pershing Guernsey, which is for those clients that want to keep their portfolio completely offshore. That obviously benefits from no VAT on the annual management charge too. We have Pershing UK, which is Tier 1 investor visa clients and standard UK resident portfolios. And then we've got access to Pershing New Jersey, which is any US connected clients, and that's basically US citizens, or for example, a UK resident with a green card in the US. So we've got the full options there. And in terms of performance, because of the amount of mandates and strategies that we manage at Tilney's, I didn't want to include too many slides on performance, only to say that returns have been strong since inception across the board. We do send our performance figures to ARC PCI in the UK, and also for those of you who are members of STEP, we contribute to Enhance MPI, and we can send performance figures through on request. Next slide, please. Next slide as well. Thank you. So we've got 4 slides here on investment philosophy and process. Don't want to cover masses of detail today, but the key message here is that we're looking to preserve and grow the real value of our clients' capital through time. So how do we go about that? In terms of preserving capital, we're looking to avoid any sectors or stocks that may result in permanent loss of capital. So to give you an example, we won't buy companies that are operating at a loss at the moment or are not generating any revenue. That's uninvestable for us. If there's a market downturn, they're the first ones that are likely to go bust. So we do focus on business risk, not price risk. We like businesses that have good global franchises, high quality of management, and good financial strength as well. So we don't mind paying up for a company if it's a good business. That said, we do insist on a margin of safety. We won't just pay any price for the stock. A good example recently is Tesla in the US. That's gone from 180 billion in market cap up to 300 billion in market cap in a matter of weeks. Investors have been speculating on that particular stock, and that's just too expensive for us. Again, that's an uninvestable investment for us. And looking at preserving capital, I've got an example on the next slide, but before we move over, we look to preserve capital on the downside, so it's easy to grow on the upside and compound those returns. And when we're looking at our strategies, they're based on inflation plus. So we're looking to beat inflation after dealing costs and taxation. And if we move on to the next slide. So this gives you a few different examples over the last 10 years where we've had short, sharp corrections in markets, how stock markets have performed and how we've performed at the same time. So we think that limiting the downside will deliver better long-term returns for the client, lower volatility, and at the end of the day, the client's going to be more satisfied. So fresh in everyone's minds is obviously the first quarter of this year. If you look at the bottom right-hand corner of the slide, you can see the UK stock market dropped by around 25.3%. That's the black line. And this was, of course, around the coronavirus pandemic. Our highest risk portfolio, which is the pink line, only dropped 13.7%. So we are going to drop in a market correction because obviously we have an element of risk in portfolios, but at the same time, to only get 50% of the drawdown in a large market correction, we think is quite satisfying for the client. And what that's meant is, as the second quarter markets have recovered, we've recovered quicker than many of our peers, and actually a lot of clients are back to square one that they were at the beginning of the year, which is obviously quite pleasing to see. Next slide, please. So this gives us an overview of our 10 principles of manager selection. So when we're investing into multi-asset solutions for our clients, there's 10 different areas that we look at when analysing fund managers. So I won't go through them all, but we like them to meet 7 or 8 of these characteristics in order for us to buy them. One of them is, does the fund manager significantly invest in his own portfolio? Does he feel the same pain as our investors when there's a market correction? There's nothing like a market correction having your own money in the fund to focus the mind, and because they have a vested interest in that fund doing well. And 2 other points to note is the fund constrained by benchmark, and do they hold a concentrated portfolio? So again, we're paying these fund managers an active fee. We don't want them to hug the index, otherwise I may as well just buy an index tracker for a quarter of the price. And do they hold a concentrated portfolio? So do they have conviction in what they're doing for our clients? Next slide, please. So this is more.
Ben, are you still there? I think he's frozen out, Jonathan. Do you want to take over quickly? Because it has gone frozen.
Okay, sorry. Yeah, he's frozen. So
if he comes back,
is he back? No. What he's talking here about is principles of stock selection, what makes the companies. And we're a company that believes it's really important to follow a strict process the whole way through and continue with that process. So don't break the rules of the principles of stock selection, ostensibly what he's talking about, because that's when it causes issues. If you say, yes, but in this situation, it's slightly different and we'll break that rule, that's when you run into those difficulties. Your next slide, please. Unilever is a good example of a business that we've liked for a long time, and it fits into an awful lot of our portfolios. Why? Well, because it's got a wide range of products which everybody knows, which are dependable and which everybody uses the whole time. So it gives it a good, solid, reliable cash flow into the business, which is a vital part of stock or investment selection. It's had, as you can see over the bottom, consistent organic revenue growth of over 4% per annum, which is well above the average. So Unilever is a classic sort of company that we rely on because it can create returns in good times and bad times. Next slide, please. I think that's mainly what Ben was going to talk about, Simon. Sorry, I was thrown slightly in the deep end there with picking up from him, but I think those are the key points. It's about following a strict process and building a portfolio and connecting it with the client's particular circumstances.
Just a quick question, and Ben, you only just lost out the last couple of minutes, so hopefully you can still hear us. But the quick question was, not an immigration question, what value of investments would allow a bespoke portfolio? What's the minimum threshold, Jonathan? Ben also, because he's probably listening, minimum threshold for a bespoke investment portfolio?
Our usual minimum at that level for an international client would be 750,000. Okay.
And for a tier 1 investor visa to the questioner, would be a 2 million qualifying investment. Thanks for keeping us to time, Jonathan and Ben. Couple of questions. I think Ben may be coming back online. Just on immigration, English language requirement. Now, to get a citizenship after ILR has been enjoyed for 1 year, there is a requirement to pass a life in UK test, and an associate of mine from Eastern Europe had to learn his lines and ended up knowing more about English history than I did for a week or two, and that was a requirement to pass that test. But for a tier 1 investor visa application, there is no strict minimum language requirement. There is for the innovator visa, there is for the sole representative visa, but not for a tier 1 investor visa. So if the applicant is a little nervous on their extent of English language, they're probably being modest. It's not a requirement, especially for the visa. So that answers that one, and we'll cover that up when we send. We'll cover and make that good when we send the presentation through. Someone's asked sovereign fees, not fees, but fees and costs relevant to getting a tier 1 investor visa. Well, I can tell you a sole representative visa, 7,000, an innovative visa, 10,000, and a tier 1 investor visa, all told, it's about £15,000. However, an independent consultation, is available, a written report, and that's less than £1,000 to identify your situation. And if it wasn't positive, we wouldn't deliver that. So it's all going to be rather positive in terms of delivery. I better leave the other questions, but one other questions to the end, because some are quite sophisticated, respectfully. One question for Tilney is an investment in mergers and acquisitions qualified for tier 1? I would point out that the qualifying investment must be in active commercial companies. It's no longer possible to buy gilts, treasury bonds, and the like. So it's got to be an active investment. And if the mergers and acquisitions project could be active and commercial, then it's probably going to be qualifying investment. Ben, Jonathan, do you want to answer that before we get on to part 3? Can't hear you. Can't hear you, Ben.
Oh, okay. Yes, as you say, yeah, possible. In terms of what we look at for clients, we stick to the fairly plain vanilla options of direct blue chip listed stocks and direct corporate bonds. But yes, it is possible under the qualifying rules.
Okay. And do you facilitate the buying of gold, Tilney? And then we will get on to the next section.
In tier 1 visa portfolios or just in standard portfolios?
General. General.
Yeah, in general, yeah. I mean, we do. We actually, that's one of our major asset allocation calls at the moment. So within our multi-asset solutions, we tend to have around 5 or 6% in gold. A couple of different reasons, but the main one is the debasement of currencies through quantitative easing. So we do think inflation will creep up very quickly in time because of the amount of money in the global system, and gold is a store of value. So yes, we do buy gold for our multi-asset solution clients. Absolutely.
Very good. Just to point that out, the buying of gold, which is not really an active commercial business, doesn't qualify for tier 1 investor doesn't qualify for a tier 1 investor visa. And the buying of a £10 million house, which was another question, well, whilst it would be rather an enjoyable hamlet to own, it doesn't get you a tier 1 investor visa. It actually doesn't get you any immigration visas buying property. That's a lifestyle asset unless you are involved in the construction of property, which would be a tier 1 investor visa permissible investment. So buying main residences and passive investment doesn't qualify you for the investment criteria. Right, next slide please, Tiffany. We're going on to part 3. Thank you to the questions raised so far by the audience. We've had about 5 minutes of questions so far that I've taken up the allocated time of this hour, so we may just run over with questions. I'm into part 3 and I'm introducing, before Stuart introduces me, I suppose, I'm introducing Stuart Stobie, who's been involved heavily and at a very high level in the trust and fiduciary services industry for the last 20 years, spent considerable time in Hong Kong with our sister headquarters at Sovereign in Hong Kong, and before that he was with Grant Thornton, and whilst he was in Hong Kong he had the responsibility for the development of our business in and throughout Asia. And like myself, he then became in the time that hardly overlapped, a managing director of our Gibraltar office. He is based in the northwest of England in the Wirral, because that is the home of Sovereign Pension Services, our regulated FCA pension administration and pension trustee company. So focusing for the UK of Sovereign corporate and private client activity in that area, is a member of STEP as well. Stuart, do you want to introduce me quickly?
Yeah, good day everybody. Thank you for all attending. As you well know, people who know Simon know he's far too modest to talk about himself, which is why I'm doing it for him. Simon has over 30 years experience and expertise in international tax planning, trustee, corporate services, fiduciary and market industry. As MD of Sovereign Trust in Gibraltar, he's the chairman of the Association of Trust and Company Managers, and was a member of the Gibraltar Government Financial Sector Legislation Committee. He moved to London in 1996 to establish Sovereign's UK office here in the UK, and he remains, as he said, managing director. Simon's been a director of Sovereign, also along with that, chairperson of the UK chapter of the Offshore Institute. Is still the Vice President of the Royal Society of Fellows and continues to be a member of the Institute of Management. He's a founder and chairman of International Professional Association Limited. Simon is a regular lecturer and speaker at tax planning and financial services conventions throughout the world. I will now, that's acceptable presentation, I will now move on to this width. I'll start with, sorry, Simon, you want to?
Yep, I'll start with this slide and then hand over to Stuart on trust. Yes, Stuart?
Yeah.
Okay, so why the UK taxation regime? This is the precursor to Stuart's delivery this morning, complemented by myself. Two taxation systems for the United Kingdom, and why the United Kingdom tax regime is so beneficial for persons that are non-UK domiciled. And in that paragraph there, ladies and gentlemen, you've got what is domicile, country of birth, the country of person's former home or permanent home, where the parents were born. There's a lot of factors governing domicile, but you can quickly determine the fact that I was born in the UK, despite living overseas for 10 or so years, I've still got a UK domicile, whereas many of you or many of your clients or associates were not born here, grew up in a particular country overseas, educated overseas, still have substantial social and economic ties with the home country, and probably will go back to that country at some time in the future. Therefore, that person will have the benefit of being non-UK domiciled and therefore not subject to tax on their worldwide income, worldwide gains, worldwide assets. They enjoy that sort of not quite tax-free holiday, but for someone coming into the UK on an immigration visa and taking advantage of the financial services environment and everything else that the UK offers, for the first 7 years, they are not taxed on overseas income and gains, especially if they're not remitted to the UK. They're only taxed on UK sourced income, UK earnings, and certainly they are well beyond and well outside the inheritance tax regime of the UK. So those are the 7 years of almost offshore life in terms of overseas income, overseas gains not remitted to the UK will not be subject to UK tax control, even a UK tax return. And that period of time can be extended to 15 years. So overseas income, overseas gains, rental income, overseas dividends, gifts, assets that are accumulating, assets that are generating income that are reinvested, no tax charge unless the income and gains are brought in. But from year 8, as I call it, you've got to sort of pay your sort of annual season ticket of £30,000 to enjoy that status, especially if you have quality overseas income and overseas gains, and that goes up to 60,000 for year 13, 14 and 15. After 15 years, ladies and gentlemen, if the non-UK domiciled person is still in the UK, then they're a regular UK taxpayer like Stuart and myself. Like they become deemed UK domiciled, so they're taxed on their worldwide income, and they're exposed to UK inheritance tax, which is why it's so important for non-UK DOMs to settle a trust at a very early stage. Returning expatriates can use the benefit of trusts and family investment companies, and therefore you can enjoy the non-DOM status more or less with a trust in place, which was what Stuart is going to talk about now. Thank you very much. Next slide, please. Okay, Stuart.
As Simon pointed out in the previous slide, there is obviously a lot of benefits of being non-UK domiciled, but obviously there's also a lot of pitfalls when people set foot in the UK and don't realise that they are creating various tax issues for themselves, and therefore it is imperative to come up with a construct which is, as Jonathan mentioned earlier, is useful for them in their own personal terms, but also can protect from any tax issues. And one of the things that we would ask clients who are coming to the UK to set up is the excluded property trusts, EPTs, because they, as you can see from this slide, they can be established to basically ring-fence assets outside the scope of UK IHT, even if then the settler comes and resides in the UK. So and also it does allow you access to those assets. They're not locked up forever and a day. Obviously, it is, as Simon said, it's imperative to get that in place before actually picking up domicile. Although obviously it's a number of years, but it's amazing the number of clients who don't put it back into the last minute. So it's imperative to get this plan in place. Next slide, please. We just thought this would be great. This illustration just shows basically what you can use a trust for. As you can see, there's a for the set law, as I say, we would obviously propose that in this case would be non-UK domiciled, and they would settle assets into the trust. Obviously, we would propose us as trustees because we've got licenses in various jurisdictions to do that. And I've also recently started a discretionary trust, so non-UK obviously. And as you can see, there are various options in what the trust can do in terms of what those cash in terms of owning assets is a fairly flexible tool. Obviously, as trustees, sorry, load my webcam.
Hi, Stuart. We've just cut off your webcam, so hopefully your audio will sound better. You're breaking up quite a lot.
Right, better. As you can see on the bottom left-hand side of the slide, you can see the various benefits in terms of succession planning, asset protection, deferral of various taxes, and keeping yourself outside the AST net, and also removing AST in the event of demise of settlers and beneficiaries. And as I mentioned before, and Simon's mentioned before, that obviously the settlor should ideally be outside the UK or non-resident UK for less than 15 years. Next slide.
Okay, next slide, please. Stuart, when you get back, when you come back, just move away from your screen a little bit. I think that's the echo. Right, thank you, Tiffany. I will whiz through the few slides because our colleagues would like to have more questions, more time set aside for questions. But this just reiterates how a trust could be organised by a non-UK domiciled individual that might want to come in under one of the immigration programs. If they're a member of the EU, they can enjoy rights of residency at the moment under a settlement or pre-settlement visa, providing you get it done this year, please. If you're non-EU, you've got the immigration programs to take advantage of. But often, aside from the investment for a qualifying visa, especially tier 1, which can be liquidated once you get ILR, the most important asset is in terms of value is often the home. And the home, regardless of where one is domiciled and resident, as it's a UK asset, it will be exposed to UK inheritance tax come the demise of the last surviving spouse. So here you can use a trust because the investment doesn't have to be in one's own name for immigration purposes, because a home doesn't qualify as an investment for immigration purposes. So you could have a trust, an offshore interest in possession trust, structured to own the asset, even with bank finance. The beneficiaries can be the head of family, the main applicant, one of the parents or both parents. So the settlor can enjoy, the beneficiaries can be spouse, children, and others. And in this view, because the client or the settlor is non-UK domiciled, they can contribute the proceeds into the trust without a charge. There's no ATED, which is, if no one knows what ATED is, it's annual tax and envelope dwellings, awful expression and title, but it's like a mansion tax. Because it's not owned by a company, that doesn't apply. If one of the beneficiaries live in the property for at least 90 days a year, they can claim main residence relief if the property is sold, so no capital gains tax. And there's no inheritance tax on the demise of the settlor and beneficiaries. Next slide, please. So the inheritance tax law in this country, despite the UK offering major tax concessions for non-UK domiciled persons, the inheritance tax law and the rate is the worst in the whole of the worldwide world. It's awful. It's 40%. When you think that people tremble in fear of having to deal with the US IRS have an annual exemption for inheritance tax and estate duty of 11.5 million. We have a threshold of 325,000. So big deal. Your first £325,000 of qualifying assets are not subject to inheritance tax, and anything else above that will be exposed to 40%, especially for UK domiciled persons, UK returning expats that may have been non-UK domicile but are coming back and their domicile reverts after after 1 year, sorry, and those that become deemed UK domiciled in 15 years time or more will be subject to this rate of tax. The 40% doesn't apply for non-UK DOMs that have lived in the UK for less than 15 years, and doesn't apply, sorry, non-UK DOMs that haven't lived here for 15 years and have overseas assets, but after 15 years, all of their assets will be exposed to UK inheritance tax. So the application of a trust is rather special, and Parliament's legislated for the establishment of trusts because trust property is not exposed to UK inheritance tax, even if the settlor and the creator of that trust was to live here for another 48 years because they're 52 today, for example. So that's the sort of snapshot of inheritance tax. Seminars are held for many days on inheritance tax, and there's the summary of inheritance tax issues. Next slide, please. So back to Stuart, qualifying non-UK pension scheme, Stuart, and if you could rattle through this and the illustration so we can take time for questions, sir, please. Mute.
So the organizer muted me. So we'll just quickly touch on QNAPs as another tool for planning, for holding various assets. As you can see from the slide, that we can utilize them for investment in residential property, and you are allowed member loans. But you do have to remember, as you can see, these are pensions, and therefore there are retirement ages to be considered, and therefore you do have to realise that these aren't sometimes not as flexible as trust. And again, you have to consider the scenario. That said, they're also very beneficial for people who have hit their lifetime allowance on pension contributions here in the UK, and there are actually, as you can see in the slide, some benefits. We are furthermore seeing far more use of these, as I said, to you hold property, residential property, because it's outside the scope of ATED, which Simon touched on previously, and also not reportable on notice. We also have a lot of not only owning direct owning property and other assets, but also good for shares in companies. So again, you have to consider the trustees of that pension scheme will have to look at subsidiaries most beneficial for that pension. So again, not always as flexible as trust, but definitely worthwhile considering, with the pension regulations in this country being changed on dealing with this on a regular basis. And I know our own pension team are access regularly scratch their heads over pension rates here in the UK. Next slide, please. Again, this is a brief illustration just to show again that similar to the trust we're using Guernsey in this instance, it could be Malta, it could be Ireland, depending on your requirements. But again, you transfer the branch transfers cash into the overseas cash into the QNAPs. There are no tax breaks from doing that, but also then it allows you to run and protect your assets and invest them as you can see them under the assets. But I don't think I'll go for that. I'm conscious of time, so go to the next slide, please.
Okay, Stuart. So going back a little bit on the application of trusts, especially the ownership of your main residence. I mean, why make the HMRC as a beneficiary of 40% of your estate when you can remove it? QNAPs, incidentally, are specifically for UK DOM. No, specifically they are multi-purpose. Say they are applicable to UK DOMs, deemed UK DOMs, non-UK DOMs. And it doesn't really matter what age you are as long as you're not way past the pension retirement age. So it has major applicability in terms of planning, regardless of domicile and residence. This is a particular example. I'll canter through this as quickly as possible because we've got some questions. If you can all stay on for a few more questions. We've still got way over 100 in the webinar. So a QNAPs can own property as long as it owns traditional other investments and possibly has an investment advisor appointed. The contribution into a QNAPs, even by a UK domicile person, is not subject to a lifetime inheritance tax charge. The QNAPs, again, could have a wide variety of investments, including UK property, but you would use an overseas company to buy the UK residential property, and having the overseas company owned by the QNAPs, since net rental income will only be subject to 19% corporation tax, whereas if the QNAPs directly owned it and received rental income, you'd have the income tax charge of 45%. The QNAPs can appoint the member as the person to enjoy the benefits of the pension scheme. He can also take He can also take loans out, 50% of the value, and it could capitalise the offshore company for the buy-to-let residential property, not your main residence, ladies and gentlemen, because it's still got to stack up as an international or a pension scheme. So the benefits in the left-hand corner: no lifetime IHT, ATED letting exemption, and no UK IHT come member demise. Net rental income subject to 19%, not 45%. Income tax charge. Gains on sale will be subject to 19%, not 28%. No 10-year anniversary charge, and mortgage interest opportunities as well. Next slide, please. Traditionally, UK companies are being used to undertake a buy-to-let investment property. There's a good example, but this example doesn't protect the investor from UK inheritance tax, because the value of the UK real estate would be seen through, and the UK investor will be exposed to UK inheritance tax, even if they were non-UK residents, non-UK domicile. Just gives you an example of what we do with structures and arrangements, and those are the examples. Next slide, please. Right, family investment companies, ladies and gentlemen. We've run a little bit over time on these, but typically they are highly relevant to persons returning to the UK as a UK resident. It's a company that generally invests rather than trades. Profits are subject to a low corporation tax of 19, whereas the highest rate of income tax is 45, so there's a benefit. The founder, shareholder, head of family, parents are able to take control, which they wouldn't have through a trust. In any case, a trust wouldn't work for UK DOMs or deemed DOMs or returning expatriates. Allocations can be made pursuant to IHT savings. So I'll come on to that in the example. Trusts are no longer any good for UK DOMs and deemed UK DOMs, and these are used much more compared to what they were used in the past. It is, ladies and gentlemen, a typical UK company. The only difference between a standalone or a standard UK company compared to one of these is that there's different share classes. And the idea of having different share classes is that the head of family or the parents own all the share classes in day one. They contribute their capital and loan capital on day two, and on day three, or whenever they, or at the earliest possible convenience, they gift certain classes of share to their children and other loved ones. And as they are likely to live a lot longer than the older parents, you've got the IHT natural advantages. And again, it's a UK company, hardly an overseas clever arrangement. So there's lots you can do with UK arrangements, and there shouldn't be any inheritance tax charges going in. And come the demise of the parents, there shouldn't be any inheritance tax come their untimely demise. Next slide, please. So the core structure: a regular UK company, nothing specific. It is a UK company as what is filed on the Registrar of Companies. But there are three classes of shares. A shares are the voting shares, which would be held by perhaps the parents, and they would be members of the board of directors enjoying voting control. They would be shareholders of all classes on day one, contribution, loan capital and regular share capital going in on day two, and then they gift the shares, the B shares and C shares, to others, with the parents just holding on to the voting shares. The gift shouldn't be subject to any inheritance tax, providing they live for 7 years. Loans can be contributed at the start so that the loan can be repaid, giving a somewhat of a passive pension retirement provision. And none of this is subject to the lifetime inheritance tax rules or any scheming, DOTAS and anything else like that. So it's a vanilla UK arrangement with some clever share classes. Next slide, please. That's the example, ladies and gentlemen. Again, there's hours and hours spent on these sort of arrangements in a normal summit where you sit down and listen to speakers, but I've just done this in 5 minutes. You've got the FIC, which would have cash investments and investment portfolios. You could appoint Tilney as the investment advisor, or your own IFA. It is a UK company after all. It's an investment company, not a trading company. Contributions going in. The parents would own A shares, B shares, and the golden share, which I call C shares. They gift the dividend and capital shares, the valuable shares, to the children, and providing they survive 7 years, there's no inheritance tax come their untimely demise. There's no pre-owned asset tax, especially on the B share that is held by a trust. No capital gains tax going in because it's cash or assets that have not latent with gains. And the golden share is held by a UK trust, perhaps organised by a sovereign, because come the event of the untimely demise of the parents who were or are board members on the voting share, owning the voting shares, the trustees will have rights of veto in how the UK company should be administered, controlled, assets spent, assets reinvestment. So no hostile B shareholder can aggressively sell the company or the assets to the detriment of beneficiaries. Corporation tax at 19%. So family investment companies, ladies and gentlemen, very good for returning expats, for those that have a volume or a big value of assets, entering the UK, and perhaps in addition to the tier 1 investor amount, you've got QNUPs, and you have the application of trusts. So I will now, with that all delivered more or less in just over the hour, we've had 10 minutes of questions already. I would now like to take some questions, please. And please introduce your questions. There's still 117 of you in the webinar. And the first question I've got here, just bear with me for 1 second, is Tilney's. Qualifying investments, which must be active and commercial, could you please give an example portfolio or an example stock and qualifying investments for a tier 1 visa, please?
So before I got cut off by the internet before, did you see my slide on Unilever as an example?
Yes.
Yeah. So I mean, just if we cover that one off, just because you guys have seen it, you know, that is a qualifying stock in terms of, you know, it ticks our boxes in terms of the principles that we're looking at for a company. You know, has low levels of leverage, as a global franchise. I think around 2.5 billion people use their products daily around the globe. And over the last 20 years, in terms of the capital return on the stock, it's about 9.5% per annum, which actually compounds up to a 3 times return on your share price. So over 20 years, you know, that's a stock that ticks all the boxes. It's also increased its dividend payout by 11 times as well. Obviously registered in the UK, you know, so that's something that would that qualifies for the tier 1 investor visa and is a core holding for us.
But it's an active trading company that the investor must make in order to secure their investment visa for the period before they qualify for ILR, isn't it? It's not gilts, it's not treasury bonds, it's not euro bonds. It must be an active commercial company, Ben, isn't it?
Yes, yeah, correct, yeah.
Okay. The next question, sorry, I'm just trying to pull it up on the other screen. I've got, as someone being eligible for an ancestry visa, do you think is any reasonable expectation of a visa opportunity disappearing in the mid to long term future? I would like to say no, there's no pending legislation in place to remove ancestry visas. and our Home Office licensed immigration expert will be able to deliver that if the questioner would like to get further information. Kerry, any points from you on that other than mine?
No, I agree, to be honest. You know, they're not changing regulation with regards to ancestry visas at all. So, as you say, excuse me, my voice is gone.
A question on the family investment company. Can you combine this family investment company structure with ownership of UK residential property? Yes, you can, and it can be a buy-to-let residential property portfolio used to purchase brand new property, but not your main residence, lady or gent who raised that question. Technically, it could own a trading company as well, although you may want to separate trading companies from passive investment companies, because if a trading company is owned by a qualifying percentage of shares and it remains a trading company, an active company, you can usually qualify for what's called business property relief, which really means that the value of the shares in the trading company will not be exposed to UK inheritance tax upon demise or the demise of the last surviving spouse. So be careful on trading companies on the left, investment companies on the right, and the investment company can own property, not the main residence, but I'd keep trading companies separately. But yes, you can combine them on a case-by-case basis, underpinned by some useful tax advice. UK real estate, does UK real estate in the UK form part of the Tier 1 investor visa? No, it doesn't. The purchase of buy-to-let property, the purchase of a main residence does not qualify for a Tier 1 investor or any actual investor programs, and the actual investment made in qualifying investments must be maintained for the duration of the visa before and if the investment goes down, you've got to top it up, and the 2 million, the 5 million or the 10 million must be maintained at all times. Again, getting sole representative visa, it is correct that after 5 years the employee has to leave the UK for 1 year. No, that is not correct. The sole representative visa has the same benefits of a Tier 1 immigration visa, and after 5 years you should be able to qualify for indefinite leave to remain on the basis you haven't been absent from the UK for any more than 180 days per year. So you don't have to disappear and come back in, not at all. So that was that question. Just looking for any more questions. Kerry, do you have any, in view of the questions that are coming on citizenship and buying some time for myself in order to get as many questions out there as possible, any other observations you'd like to bring in terms of the citizenship interest we're getting? So.
You mean across the board?
Yeah.
Yeah. There are wide, as we've said, there's a wide range of options available, and most of the what are referred to as golden visa options, yes, they do allow for investment into property, every single one of them. But this is obviously not the case in the UK. It is more about encouraging investment into the UK markets as such. Now, you'll also find this. I mean, in the residency and citizenship world, the property sector has done very well in claiming it for itself. When I mean that, I'm talking about if you look at the Cyprus program, the Portugal program, and so forth. And property developers and agents will often have people believe that those are the only options available to them. But in fact, there are corporates, you are able to establish companies, you are able to invest in shares from the other programs as well, or direct into investment funds. So it's worth bearing in mind when you're looking at residency and citizenship programs that they are actually about investing into the country itself. And so whilst people will have you believe that property is the only option. Sometimes it's definitely not.
Okay. The one question was the assets, the asset portfolio is overseas, offshore. It's difficult to liquidate and bring it to the UK. Can the assets remain offshore, held under the name of the person or the applicant and not brought into the UK? Tilney's, I've got the answer to this, which you need to bring the assets into the UK and invest in qualifying UK investments. Even if the assets were offshore and investing in qualifying investments, I still think you've got to break that investment portfolio, liquidate some proceeds and bring that into the UK for making an investment in qualifying assets, don't you, Ben and Jonathan?
Yeah, that's correct. Yeah. And the cash that we receive to invest has to come via a UK bank account as well.
Has to come into the UK bank account. Where it's absolutely imperative that you spend a bit of time and allow time, I would say 2 to 3 months, for a bank account to be opened with a private banking institution, one of the institutions that Tilney's work with, that Sovereign work with, often they're similar. Ironically, a bank account opening criteria can take longer than the process to get a Tier 1 investment visa. You probably get a Tier 1 investment visa if you go on the fast track status and pay a couple of £100 more than you would actually getting a UK bank account. But Tilney's and Sovereign can absolutely help you with that process. Now, there's another question coming in, and when the count goes below 90, I think we should call the webinar to a close and officially thank you, because the more people that leave, they won't be able to listen to a thank you. Can a non-UK citizen, permanent resident UK, work in the UK without the need for a work permit? Can a non-UK citizen, okay, a non-EU citizen then, be permanently resident in the UK, work in the UK without a work permit? Well, if they obtain, Kerry, a Tier 1 investor visa, once they get that visa, they can work for different companies, can't they?
Yeah, that's correct. They can establish their own company or work. You don't. It gives you the right to remain as such, so you can work in the UK.
So you've got the same employment rights under a Tier 1 investor visa, but under a sole representative visa, you have to be a director of your own UK company that becomes the subsidiary of the parent company. The last one we did was in Turkey. So the young son came to the UK. He became employed by the UK company that was set up and became a subsidiary of the Turkish company. So he could not compete with other employment until, of course, he got indefinite leave to remain, which is in 5 years' time, and the clock's ticking because he's into his second out of his 5 years. And no, for a Tier 1 investor visa, you don't have to wait for indefinite leave to remain to acquire employment rights and status. The other programs you do, of course. Ladies and gentlemen, we have actually gone down to 90 from the 160 welcome attendees to our webinar. I've dedicated as much time to the questions as we can. We've had contributions on the questions and answering to the questions from Jonathan and Ben, from also Kerry. Stuart's back online now. So can I just have some closing comments, please, starting with our friends from Tilney. Jonathan, in his windmill, would you like to make some closing comments? Mute.
Mute.
Jonathan? No, can't hear you.
Sorry, can you hear me now?
Quickly, please. Thank you.
Right, so just quickly, my key point about it is plan for everything, understand the client circumstances. You've heard a lot about structures today, you've heard a lot about answers today. All of those are actually relevant, and I've seen many of them and worked with many of them over a number of years. But the key thing is have a clear plan about the client's circumstances and clear understanding, and stress test that plan before you commit to it, because if you don't, that's when you have issues and you have to start unwinding them. So that's kind of my key point.
Very good. Ben?
Yeah, so the main point I was trying to get over before the internet cut out earlier was that, you know, we have a variety of different investment solutions for a variety of different clients, but the main aim for us at Tilney is to work on your behalf on both wealth planning, wealth structuring and investment management as well. And that also brings in other advisors such as Sovereign to work on your behalf. But the aim is to give a holistic solution across a variety of different areas for the clients.
Thank you, Ben. Stuart?
I'd like to echo what Jonathan said in terms of planning. Many times where we see clients sort of partially do it is the planning to get themselves simply the visa to work in the UK, and then forget that they just assume that they're not subject to the same tax rules. That is key to get some tax advice when arriving, particularly bringing family and investing into other companies, educating kids. So again, to jobs and plan and talk to the various advisors from people like ourselves and tax advisors that we can bring.
Okay, which we can all facilitate. Closing remarks, Kerry, and then I will bring it to a close.
For myself, I mean, really, it's a combination of what the others have said. You know, I head up the Residency and Citizenship division, but it is key, you know, when you're looking at these, whichever program it is, whether it's the UK or elsewhere, that you do use them as a base from which to structure, as Stuart just said, a tax efficient strategy for the clients. And in most cases, this is not happening, but it is very important.
Okay, thank you very much. Ladies and gentlemen, there is a poll. There's still over half of you that attended today. If you don't mind doing the quick poll, and do be advised that there is the panelists' notes presentation PowerPoint that is going to be sent to you before the end of the week. We are also going to disseminate some of the questions. There was a tier 2 immigration question, which will take another 20 minutes to answer, so I'm not going to put you through that. So we'll answer the questions if we've not covered any. I think we've covered way more than 50%, and we've allocated time. We've had about 20 minutes of questions. That's why we're about 30 minutes over time. So thank you for listening. You'll get the presentations, you'll get your answers to the questions nicely raised. Please complete the poll. Thank you for your undivided attention. It's a pleasure to host this, and I speak for Tilney's and all of us, Stuart, Kerry, and Stuart and Kerry at the Sovereign Group. Wish you a very good end of day, good summer, and you'll be hearing from us again shortly. Thank you very, very much, ladies and gentlemen. Good day.